What if I told you that the number 25 could be the difference between building real wealth and watching your entire portfolio collapse overnight? Not 50, not 10, 25%. It's a number most investors ignore until it's too late. And by the time they realize what's happening, they're staring at their account, wondering where it all went wrong. Here's the thing. You can spend months researching stocks. You can analyze companies. You can follow every finance guru on the internet. But if you don't understand this one rule, none of it matters. Because this isn't about picking winners. It's about surviving your own mistakes. And let me tell you, everyone makes them. So let's start with a simple question. How much of your money would you bet on a single idea? Think about it. If someone handed you $10,000 right now and said, pick one stock, go all in, would you do it? Most people say no. That sounds insane, right? But here's what's wild. Those same people are doing exactly that without even realizing it. See, the 25% rule isn't some complex trading strategy. It's not about timing the market or finding the next Tesla. It's about something way more fundamental. Something so simple that it feels almost boring. But boring is what keeps you in the game. And staying in the game, that's where wealth actually happens. Let me paint you a picture. Imagine two investors. Both start with $100,000. Both believe in the same stock. Let's call it Tech Dream Incorporated. It's got momentum, great reviews, everyone's talking about it. Investor A puts $25,000 into it, 25% of their portfolio. Investor B, they go bigger. They put in $50,000. Half their money. They are confident. They've done the research. They believe. Now here's what nobody tells you when you're making that decision. You're not just betting on the stock. You're betting on your ability to predict the future. And the future? It doesn't care about your research. 6 months later, Tech Dream Incorporated drops 40%. Not because it's a bad company. Maybe the market shifts. Maybe there's a lawsuit nobody saw coming. Maybe the CEO tweets something stupid at 2 a.m. doesn't matter. The stock tanks. Investor A, they lost $10,000. It stings. It hurts. But they still have $90,000. They can recover. They can learn. They can try again. Investor B, they lost $20,000. Their portfolio is now sitting at $80,000. That's not just money. That's psychology. That's stress. That's a voice in their head saying, I should have known better. And here's where it gets dangerous. They start making emotional decisions. You see, investing isn't really about money. Not at its core. It's about managing your own brain. And your brain, it's terrible at this. When you lose 20% of your portfolio, you don't feel 20% bad. You feel like you failed. You feel like everyone else is winning, and you're the idiot who got it wrong. And that feeling, that's what makes you sell at the bottom. That's what makes you chase losses. That's what destroys wealth. The 25% rule is protection, not from the market, from yourself. Now, let's go deeper. Because this isn't just about one stock. This is about how you think about risk entirely. And most people, they don't actually know what risk means. You know what's fascinating? When people talk about high-risk investments, they think about volatility. They think about crypto crashing or penny stocks going to zero. But that's not risk. That's just noise. Real risk is a permanent loss of capital. It's putting so much into one thing that when it fails, and it will fail sometimes, you can't come back. Think about this. If you lose 50% of your money, how much do you need to gain just a break even? Most people say 50%. Wrong. You need a 100% return. Because you're not starting from where you were. You're starting from half. The math gets brutal fast. And this is where the 25% rule becomes your lifeline. Here's what it actually does. It forces diversification. Yes, but more than that, it forces humility. It forces you to admit that you don't know everything, that you can't predict every outcome, that even your best ideas might be wrong. And that admission, that's not weakness. That's intelligence. Let me tell you what happens when you ignore this. I've seen it over and over. Someone gets a tip. or they read something that makes total sense. They feel that rush, that certainty, and they think, this is it. This is my moment. So they go big, 40%, 50%, sometimes more. And maybe it works. Maybe they get lucky. And that's the worst thing that can happen. Because now they think they figured it out. They think they are special. Then the next one fails. And the one after that. And suddenly they are not investing anymore. They are gambling, chasing that first high. And the 25% rule, it would have stopped that cycle before it started. But here's where most people get this wrong. They think the rule is about limiting upside, like you're playing it safe and missing out on big wins. That's not it at all. This is about staying in the game long enough to actually win. Because wealth isn't built in one trade. It's built over years, decades, and you can't build anything if you're knocked out in round one. Now, let's talk about what this looks like in practice. Because theory is nice, but you need to actually use this. So here's a framework. You never put more than 25% of your investable capital into any single position. That's it. Simple. But let's break down what that actually means. First, investable capital. Not your net worth. Not your savings account. Not your emergency fund. The money you can actually afford to put at risk. If you have $50,000 saved, but $20,000 of that is your safety net, your investable capital is $30,000, which means your max position size, $7,500. One stock, one investment, that's the ceiling. And here's the thing, 25% is the maximum, not the target. For most investments, especially ones you're less certain about, you should be way lower. 10%, 15%, maybe 20% if you really believe in it and you've done the work. But 25% should feel like a big bet. It should make you slightly uncomfortable. If it doesn't, you're probably overexposed. Now watch this. Let's say you follow this rule religiously. You build a portfolio of 4 to 6 solid investments. Each one is 15% to 25% of your capital. You're diversified across different sectors, different risk levels. One of them fails completely, goes to zero. Worst case scenario, how much did you lose? At most, 25%. Your portfolio, still 75% intact. You're bruised, but you're breathing. You can recover. Compare that to someone who bet 60% on that same investment. They just lost more than half their money. The psychological damage alone, they might never invest again. And that's the real tragedy. Because investing is one of the few ways regular people actually build wealth. But one bad decision, one broken rule, and they're out forever. Here's another layer. The 25% rule doesn't just protect you from losses. It protects you from regret. And regret? That's the silent killer. You know that feeling when you see a stock you almost bought, and at 10xs, it eats at you. You feel like you missed your shot. But if you had followed the rule, you wouldn't have been able to go all in anyway. So there's no regret. You played it smart. You stuck to the system. And that mental clarity, that's priceless. Let me show you something else. This rule also forces you to think critically about every investment. If you can only allocate 25% max, you start asking better questions. Is this really worth a quarter of my portfolio? What am I missing? What could go wrong? You stop chasing hype. You stop following the crowd. You start thinking like an actual investor. And here's what's beautiful about that. The more you practice this, the better your instinct become. You start to see patterns. You start to understand risk in a way most people never will. Because you're not just throwing money around. You're building a system, a framework. And systems, they compound. They get smarter over time. Now, I know what some of you are thinking. But what about concentration? What about the investors who went all in and became millionaires? Yeah, survivorship bias. For every one person who bet everything on Apple in 2005 and retired early, there are 10,000 who bet everything on companies that don't exist anymore. You just don't hear their stories. Because failure is quiet. Success is loud. But here's the truth. You don't need to hit a home run to build wealth. You just need to not strike out. The 25% rule keeps you at the plate. It keeps you swinging. And over time, those base hits add up. Compound interest doesn't care if you got rich quick. It just cares that you stayed invested. So let's bring this home. The 25% rule isn't about being scared. It's not about playing small. It's about being smart enough to survive your own emotions. It's about understanding that investing is a long game. And in long games, consistency beats intensity every single time. Here's what I want you to do. Look at your portfolio right now. Actually look at it. How much do you have in your biggest position? If it's over 25%, ask yourself why. Is it because you believe in it that much? Or is it because you got lazy? Because you kept adding to it without thinking? Be honest. And if you're starting from zero, if you're building your first portfolio, make this rule your foundation. Before you buy anything, ask, would I bet 25% of everything I have on this? If the answer is no, then why are you buying it at all? And if the answer is yes, good. That's your maximum. Not a penny more. The investors who win long-term aren't the ones who take the biggest risks. They are the ones who manage risk so well that they never have to start over. They are the ones who survive the crashes, the corrections, the moments when everyone else panics. And they do it because they built protection into their strategy from day one. That's the 25% rule. It's not glamorous. It won't make you feel like a genius, but it will keep you in the game. And in this game, staying in is how you win. So next time you're about to make an investment, pause. Do the math. Check the percentage. And remember, it's not about how much you can make on one trade. It's about how long you can keep playing. Because wealth isn't built in moments. It's built in years. And the only way to get those years, survive the moments. Now, if this clicked for you, if you felt that shift in how you think about investing, do me a favor. Hit that like button. Not for me, for you. Because that little action, it's a commitment. It's you saying, I'm building something real here. And drop a comment. Tell me, what's your biggest position right now? Are you over 25%? No judgment, just honesty. Because we're all learning this together. And if you want more of this real talk about money, investing, and the psychology that actually moves the needle, subscribe. Because I'm not here to sell you hype. I'm here to help you build a system that works when everything else is falling apart. You've got this. Now go build something that lasts.